Picture this. You're sitting at your computer, you're totally ready to make your very first trade. You spot a setup you really like, you click a button, and suddenly, whoosh, the price just drops, fast. And because of one wrong click, or actually more like not understanding exactly what you just clicked, a tiny, manageable loss turns into this massive account-draining disaster. It happens literally every single day to beginners, but it absolutely doesn't have to happen to you. Welcome to today's Explainer, where we're going to make sure you never lose money on bad execution again just by mastering order types. So could one wrong click literally wipe out your entire account? Well, for absolute beginners trading without any boundaries, the terrifying reality is, yes, it could. Unlimited losses are a very real threat if you don't know how to protect yourself. But here's the thing. I want you to think of order types not as, boring administrative buttons, but as your own personal trading superpowers. They're basically automated guards that stand by 24/7 to protect your capital and lock in your gains. All right, let's dive right into our agenda for today. We're going to cover the high cost of mistakes, entering the market, managing your risk, the perfect trade setup, common beginner mistakes, and finally, practice before you trade. Okay, part one, the high cost of mistakes. To avoid those massive blunders, we first have to understand the basic mechanics of how we actually interact with the financial markets. So, what exactly is an order? Simply put, it's an instruction given to a broker or trading platform to buy or sell an asset. But here is the real secret. Choosing the right order type dictates the exact price and the specific conditions of your trade execution. You aren't just broadly saying buy, you're telling the market exactly how and exactly when to buy for you. Moving right along to part two, entering the market. Let's talk about the two primary tools you're actually going to use to get into a trade. That's market orders and limit orders. The crucial difference here comes down to this one idea. A market order guarantees execution, while a limit order guarantees price. You literally cannot have both at the same time. You always have to choose which of these two things is more important to you at the exact moment you enter the trade. Let's break down these trade-offs a bit more. With a market order, it executes immediately at the absolute best available current price. The big pro here, you're guaranteed to get into the trade almost instantly. But the con? You're subject to what's called slippage. See, if the market is moving incredibly fast, or maybe it has low liquidity, the price you actually get executed at might be worse than the price you just saw on your screen. So this is best used when speed matters way more than the exact price. Now compare that to the limit order. Here, you instruct the broker to buy or sell only at a specific price, or better. The pro? Zero slippage. You get exactly your price. The con? Well, if the market never actually reaches your set price, your order just stays open and might never fill at all. You could completely miss the trade. This one is best used when precision matters more than immediate execution. All right, part three, managing your risk. Getting out safely. Because let's be real, getting into the market is easy. Anybody can click buy. But getting out safely, that is where true risk management happens. And honestly, that's what separates the pros from the gamblers. Enter the stop-loss order. This is an instruction to automatically sell your asset once it reaches a specific price, and it's there purely to limit your losses on an open position. Let's say you buy a stock at $100 and you set your stop loss at 95. If the price drops down to 95, boom, the position is automatically closed. You lose exactly $5 per share and not a single penny more. It is your ultimate capital protector. It completely removes that terrible emotion of sitting there, sweating, just hoping a losing trade turns around. The only minor con, sometimes short-term price spikes, often called stop hunting, can trigger your stop before the price moves back in the direction you expected. Now, on the flip side of that, we have the take profit order. This is an instruction to automatically close a position once it reaches a specific profit target. If the stop loss cures fear, well, the take profit cures greed. You buy at 100, you set a take profit at 110, and when it hits that target, you automatically lock in those gains. No need to watch the market constantly. Yes, the downside is you might close out a bit early and leave some money on the table if the price keeps rocketing upward, but hey, locking in guaranteed profit based on your plan, that's never a bad thing. Which brings us to part four, the perfect trade setup. We're now going to take all of these isolated tools and combine them into one cohesive, highly professional strategy. Okay, here's how you actually execute a full trade setup step by step. Step one, your entry. You buy at $100 using either a market or limit order. Step two, immediately, and I mean immediately, set your stop loss at 95. So your maximum defined loss is now capped at $5 per share. Step three, set your take profit at 115. Your target gain is $15 per share. Notice something here? You define your maximum loss and your target gain before the trade even has a chance to develop. Doing this completely removes all emotional decision-making in the heat of the moment. You've essentially built a protective, mathematical cage around your trade. Just look at how your defined $5 risk compares to that massive $15 potential reward. This creates a 1-to-3 risk/reward ratio. You're risking $5 to potentially make 15. This right here is a cornerstone of professional trading setups. When you have a 1-to-3 ratio, you can actually be wrong on a fairly large portion of your trades and still be highly profitable over time. Why? Purely because your winning trades are mathematically so much larger than your strictly controlled losing trades. Moving into part 5, common beginner mistakes. Because even with these amazing superpowers at your fingertips, simple human error can still completely destroy an account. Let's look at the common traps beginners fall into. First up, trading with no stop loss at all. This exposes your account to literally unlimited downside risk. Please don't do this. Second, setting a stop loss way too tight. If you put it too close to your entry price, you're just going to get stopped out by normal, everyday market noise before the trade even has a chance to work. Third, and honestly this is the fatal trap, moving a stop loss further away after entering a trade just because you're hoping the price will quote-unquote come back. All you're doing is increasing your losses. Once the stop is set, leave it alone. And finally, not setting a take profit, which usually means you end up closing a winning trade way too early or way too late, based purely on emotion. And finally, part 6, practice before you trade. We've covered the mechanics, but how do we make this permanent? Because combining these tools isn't just a suggestion. Combining a stop loss and a take profit is mandatory risk management. It's not optional. These tools define the hard boundaries of your trade, and quite frankly, they protect you from yourself. If you're entering a trade without both of these orders attached, you really aren't trading. You're just guessing. Now, a quick reality check. Please remember, order types are essential tools for risk management, for sure, but they do not guarantee profits or completely eliminate risk entirely. Things like slippage, overnight market gaps, and stop hunting, yeah, they can still happen. So this explainer is strictly for educational purposes. It is not financial advice. Your very first step must always be practicing these mechanics on a demo account. So here is my question to you before we wrap up. What is the risk/reward ratio of your first mock trade? Seriously, I want you to go set up a demo account right now, use all 4 of these order types, market, limit, stop loss, and take profit, to build out a complete mock trade. Calculate your risk versus your reward and comment that ratio down below. If you found this explainer helpful in protecting your capital, make sure to hit that subscribe button for more clear step-by-step visual guides. Catch you on the next one.